Hi everyone, this is Alexander Lim and welcome to AuthorStory, where in every episode we speak to a different author on a particular topic of interest. On today's episode is Tan Liu, who is a freelance photojournalist and has been a volunteer youth mentor for many years. He has undergraduate degrees in economics and finance, has managed distressed assets for a bank, and is now working to complete his master's degree in applied statistics, which I understand he is very interested in. His book is The Ponzi Factor, The Simple Truth About Investment Profits, and you can check it out right now by clicking on the Amazon link in the video description below. So Tan, welcome. Great to have you with us on Author Story.
Thank you for having me.
Great, fantastic. So Tan, what made you decide to write The Ponzi Factor?
Initially, I guess the project I really started back in 2009 when I finished a job at a hedge fund, and I guess you could say I initially I wrote it out of anger or wanted to show the world how the world of finance really works, because at that particular hedge fund, what I realized is that in finance, it's not always about making money. It's actually, there's a lot of tricky accounting, a lot of shady stuff that happens that deals with how you account for the money, as in you can actually account for profits without actually making it using really tricky accounting systems. This is something I talked about in a story in chapter 1 in my book. And before that, I guess you could say I was very passionate about finance. I was just like any other person that came out of school with economics and finance degrees with big aspirations to be on Wall Street. Right. But after that, it was just I was just disgusted. This also happened, of course, right around the time the whole system was collapsing in 2008. Right. But I basically saw this hedge fund run a legal, I repeat, legal. What they did was completely legal, nothing illegal. Okay. It was a legal Ponzi scheme. What they did was no different than what Madoff did, except for they were allowed to do it. So I basically initially wrote out of anger in terms of wanting to expose not just what they did, but the fact that a majority, if not all, financial strategies that involve synthetic instruments, whether it's a credit default swap, life insurance policy in their case, or the stock market, all that money that comes from somewhere else, because those contracts have no legitimate or intrinsic value, contrary to what people in finance think it has, according to financial theory. By the way, financial theory is not even a theory. Okay, it's really just an unprovable idea that people call a theory, which is also something I talk about in chapter 4 of my book called The Legitimate Idea, which is that from an academic level, if these ideas in finance are nothing short of a ridiculous hypotheses at best. They're not theories, they're not theorems, they're really just ridiculous hypotheses that you can't even prove. So initially it was out of anger for a hedge fund, but over time I realized that I needed to keep the story focused, keep the story concise, keep the story impactful, and so I focused specifically on the stock market and how the transaction of a stock, the profits actually come from other investors as well, the capital gains aspect of it. So that's initially how it started. It started back in 2012, and I didn't quite finish until earlier this year. And I'll tell you, it wasn't hard to show why the stock market is a Ponzi scheme. What's difficult is actually trying to address all these side arguments people have about how, oh, stocks are ownership instruments. Oh, what if a company pays dividends? Oh, what if a company buys back stocks? Oh, what if the shareholders bind together and try to sue the company? And it's just addressing all those side arguments what took a long time. And it took me many years of debating that to realize there was one simple, straightforward, and fatal flaw with all their arguments. And that is every single of their arguments were hypothetical situations. Oh, Tesla could make money down the road, and they could pay back dividends, and Google could buy back their shares. However, on the other hand, the Ponzi scenario I described, that happens every day, that happens at this very moment right now on Wall Street, when investors are buying low and trying to sell high, and another investor is buying high from the previous investor, it's this Ponzi scenario where investors are just shuffling money. This is not a hypothetical situation. It is an observable situation. And it is completely illogical to try to debate something that is purely observable with a completely hypothetical situation, like how Berkshire could start paying back dividends soon. So that's essentially, it took many years to realize that they all had a fatal flaw in addressing all these side arguments, and why financial theory is so fundamentally wrong is really what took a long time.
Right. Okay. Got that. So let's get a little bit to brass tacks and the basics, because for the benefit of those of us listeners who have only the vaguest idea of what stocks and trading and all that stuff is,
right?
Can you define these for us?
Sure. I mean, a stock is essentially stock is supposed to be an ownership instrument for a company.
Right.
But I explain why it's not in a moment. The thing with stocks is there's usually two ways of making money. There's supposed to be two ways of making money.
Okay. One
is through dividends, which is profit that comes from the company itself. So if you own a stock and the company makes a lot of money, Microsoft and McDonald's are good examples because they actually do pay regular dividends. And when that company makes money, they will give the shareholders a piece of that profit in terms of dividends.
Right.
Another, which is the more common one that people know about through CNBC and textbooks, is capital gains, which is this idea that you buy a stock for $10 and you try to sell it for $11 or later, right? That aspect, capital gains, is where the real issue is, because capital gains, what makes a stock price move, is not the earnings and growth of the underlying company, as it is touted in textbooks, as they try to estimate through textbooks and models, and as it is touted in CNBC, where capital gains and what makes stock price move is actually money that comes from another investor. And in a system that really just shuffles money between other investors. When you buy a stock for $10 and you sell it for $11, that money came from another investor. And that's a problem, because if it's a system that simply shuffles money between investors, that is a negative sum system, because there's fees involved. And essentially, when one investor makes money, they're taking it from another investor who also has a family, who is also trying to save for retirement, who is also trying to save for college, right? That is not an investment system even. That is a gambling system. And by definition, not my definition, but by the SEC's definition, the SEC are the Securities Exchange Commission, that are supposed to be the government entity that oversees the stock market and the legitimacy of it. By their definition, a Ponzi scheme is a system where current investors' profits are dependent on cash from other investors. It is a specific scam where investment profits come from other investors, and those investors think the money comes from somewhere else, like the earnings and growth of the underlying company. And that's where the whole issue is with capital gains. Now, I will preemptively address what some of my critics who never read the book have in mind right now. Have in mind right now. They're thinking, well, what about stock buybacks? Because there are rare occasions when companies buy back stocks as well. First of all, the key word there is rare, as in it almost never happens for a lot of companies. Second of all, when it does happen, that's a scam on its own, because people don't pay attention to how many shares the company issued right before or right after the buyback. For example, Google announced they bought back 5 million shares in 2016. However, if you look at their SEC filings, their shares outstanding did not decrease by 5 million as they should have with a legitimate buyback in 2016. Instead, in 2016, their SEC filings clearly show that their shares outstanding actually increased by 3 million. Meaning, if they bought back 5 million, they also somehow released another 8 million back in the market to make it a net positive 3 million. Tesla, so that's a shady scam right there, right? And Tesla, for example, they issued over 74 million shares over the past 7 years. Their shares outstanding have almost doubled. So right there, does it matter if Elon buys back 33,000 shares as he announced 2 months ago? It's like, okay, Elon, you bought back 33,000 shares with your own money. Hey, that's better than nothing. But you did issue another 74 million right before that. So the buyback itself is a scam. Like I said, I address all these details in my book. It was very easy to explain why the stock market is a Ponzi scheme. The hard part why it took so long is addressing all these side arguments that people have to try to defend the market.
All right, right, okay. So I'd just like to do a little sidetrack, if that's okay with you, because stocks are
Mm-hmm.
are generally seen as an investment, an investment
Mm-hmm.
vehicle. Now
Mm-hmm.
there are other investment vehicles coming out right now, like the most popular one being cryptocurrencies. What would
Yeah.
be the difference between like stocks and cryptocurrencies?
Okay. So from an investment point of view, so so from an investment point of view, cryptocurrencies are really not that much different from stocks. Well, one, I don't even like to use the word invest, but I'm just going to use it because people are just used to hearing. I prefer
Yeah.
to call them gambling instruments altogether.
Okay.
But cryptocurrencies, like, there's two types. There's actually multiple types. Let's just focus on Bitcoin, for example. Well, no, actually, let's focus on ICOs because they're more in line with stocks. The ICOs, which are these tokens that companies issue. One,
Okay.
if people want to make money, if the people who are buying and selling them want to make money, as in US dollars, then it's the same situation with stocks because they're just trading money with other investors and taking money from other investors. All right. And the funny thing with cryptocurrencies, however, is that at first, well, one, I really learned more about them in the past when the book was getting released in January and February. And initially, my thought process was, well, if I just show the stock market's a Ponzi scheme, you better believe I could show that cryptocurrencies are a Ponzi scheme too.
All right.
So initially, when I went to some of these cryptocurrency meetings, I went, of course, trying to pick fights in a way to mock them, but it was, I thought it was good practice for public speaking. So so that's initially what I did. But what was interesting is I actually learned more about cryptocurrency. They actually are somewhat more legitimate than stocks themselves because, and I'll explain why. Like I mentioned before, stocks are supposed to be equity instruments, and they are called equity instruments. However, this idea of equity comes from history. They don't actually apply to how stocks actually work now because historically, before the 1900s, I also talked about this in chapter 6, historically before the 1900s, all stocks paid dividends, meaning there was a monetary connection between stocks and the shares. That's what made stocks legitimate equity ownership instruments. This idea that came out in the past 100 years, like Tesla stocks, Google stocks, where basically stocks don't have to pay dividends anymore, and people can, and the only way people can make money is through this capital gains process. This is not how stocks are supposed to work. And without a monetary connection to the shares, the stock is not an ownership instrument. Google shares are even worse, where 348 million of their shares, half their market cap basically, those shares don't even have voting rights. They're Class C shares, tickers GOOG. Those shares, Google doesn't pay dividends, first of all, for any of their stocks. Second, those shares don't even have voting rights. And Google clearly does not back the value of their stock. So what are people trading for $1,000 out there? They're trading something that they're not going to receive any money from Google. They're not allowed to vote on anything. They're trading imaginary Google stickers, what they're doing. The ICOs, on the other hand, there's utility ICOs where these companies issue tokens, right? And those tokens, apparently, from what I understand, can be redeemed for goods and services with the company later, okay? I found that to be interesting because some people actually do buy ICOs and even Bitcoins for the sake of having Bitcoins and using Bitcoins. They're not actually in it just to make money. And in that sense, if somebody can actually redeem the token itself for services, then that's more then that's something that that company is actually giving to their token holders or investors that Google is certainly not giving to any of their investors. Because if you have a Google stock, what do you want? You only want money. That's what people invest in stock want, money. No one buys stocks and says, I love stocks. I don't ever want my money back. I just want to hold my shares of Google and never get my money back. I mean, no one thinks like that. If people do think like that, hey, you know what? Then there might be something to this valuation after all. But the thing is, yeah, people want money. And what Google simply clearly states in their filing is they're not obligated to pay them any money. Whereas tokens, they at least they can redeem services with a company. But to simplify what you asked is the real difference from an investment point of view. If people want money, there is no real difference. But however, from a actual ownership point of view, at least the people who own these utility tokens through the cryptocurrencies that these companies issue, there's something there if they can actually redeem those tokens for services with the company. There is something there.
All right. Now, I found a little bit interesting, Ton, because you mentioned how stocks were viewed prior to the 1900s and how it's different from today. How were stocks viewed in the 1900s?
How were stocks viewed, you mean?
Yeah, how are they? I mean, from what I understand, right now it works differently. The system works differently, but how it
Yes,
used to work
yes.
before.
Yes, I've touched on this briefly earlier, but basically, stocks all pay dividends. That's the key difference. Before the 1900s, most of the vast majority of profits from stocks came from the actual company and the performance of the company, because stocks were real equity instruments before, because the whole idea of stocks are meant to be ownership instruments where you own a piece of a company and the company makes money and you get a piece of the profit too. This idea that companies never have to pay their investors and their investors just keep gambling on this capital gains aspect was never meant to be how stocks are supposed to work. I mean, capital gains was meant to be a second form of profit for owning a legitimate equity ownership instrument that paid dividends. It was never meant to be the primary or only way that people can make money. And in a system that allows this, we can clearly see the evidence of the Ponzi process in effect. Tesla is perhaps the most picture-perfect example of this. So this is a company with stocks that went from $20 to $380, all while through a 7-year period, while the company lost $4.7 billion. There's nothing logical about that situation. There is no possible way in a legitimate investment situation investors can make money while the company they supposedly own loses $4.7 billion. However, it is very possible, and it is very much in line with a Ponzi situation where the investment profits for those investors came from other investors pouring money into the system. And fundamentally speaking, it has nothing to do with the performance of the company, because the performance of the company is they never made any money. They lost $4 billion. There's nothing logical about that, but it is very logical when we realize that it is a Ponzi scenario. And not only that, but the Ponzi scenario I'm describing is observable. It is something we can clearly see happening every single day. It is not a hypothetical situation like how Tesla could be the next Amazon, could make money, could start paying dividends or buying back their shares.
Okay, interesting. So this is so what you're saying is definitely not in accord with, I don't know, for lack of a better word, the party line, quote unquote, with regards to stocks and investing. What do you think is driving? What do you think are the issues driving behind the driver of this party line?
I think that the academic institutions have a lot to do with it. There's a lot of people who are at fault. One, what I described is very simple. I think everyone, you don't even have to understand stocks to understand what I just said. You don't need a finance degree to understand what I just said. That's why the book is called The Simple Truth About Investment Profits. But it really, this stems from the academic institutions that teach this subject. I saw a video the other day that somebody actually, it was interesting, somebody on YouTube actually made a video, a side video for my book, where it showed Madoff testifying before Congress about how this is Wall Street is ridiculous, that people think Wall Street is a positive sum system, that this thing is a positive sum system. And even Madoff, during his testimony, criticized the academics, saying the academics are completely delusional, teaching what they're teaching. In my research, I also, they are delusional. When I read a finance book, I look at the formulas and I look at their assumptions, and I just, it's laughable. I literally write LOL as notes in my book because it's just laughable. They're taking these hypothetical things that they can't prove, things that are completely not connected in their formulas to use in their formulas. So I think the academic institutions have a lot to do with it, and And the problem, of course, is even what I'm saying is so simple, so understandable, is that if they apply this idea, such as, hey, if there is no monetary connection between the company and the shares they own, because the company doesn't pay dividends, the company doesn't buy back their stocks in a foreseeable way, then you can't even use their earnings in their valuation. It's very logical what I'm expressing, but if they actually do this, their whole system and all the papers and thousands of textbooks that they published and would simply disappear. It's just meaningless. So, I mean, do they have an incentive in keeping it going? You bet they do. But for how long, I'm not sure, because I'm definitely coming like a storm. So we'll see.
Right. So just for our edification, would you know of any one of these academic ideas, that is commonly being touted as, this does work?
Yeah, the simple valuation. I'll just give you a formula, okay?
Okay.
Everyone knows that even the simple valuation of a company and what people see in their portfolios is absolutely ridiculous. All right, Google stocks, for example, basically the basic formula for valuation is the price times the number of shares they have. Right. Very simple. There's a very fundamental problem with that. Google, for example, has 348 million C shares, the ones I mentioned, the Ponzi assets that don't pay dividends or have voting rights.
Right.
So let's say Google was trading for $1,100 yesterday, right? Okay. And it was trading. Let's say it was trading for $1,000, and then it was trading for $1,100 yesterday. Okay, so let's say it went up by $100. Okay.
Okay.
That $1,100 would have been applied, the new valuation, the $1,100 price would be applied on every single one of their 48 million shares. Okay. The problem is, okay, and I'm going to put this very simple, that price should not apply to 348 million shares, because only 1.5 million shares were actually traded yesterday, meaning that price should only apply to less than 1% of their stocks, okay, of their shares, but it automatically applies to every single one of their shares. I, for example, can go to the market and offer to pay maybe $1,150 for just one share, as in I will contribute an additional $50, okay, to whatever the price is. My $50 would be automatically applied to the market cap for 348 million shares based on that formula. Okay, even though I contributed $50. Okay, I could basically make Google's market cap jump by a lot with my $50. I mean, we're talking about billions. Okay, so right there, you can see there's a disconnect in the logic, right? This is also why the idea that I have stocks, I could just cash it out for money tomorrow. This is also why that's completely. That is not a fact. That is actually also a ridiculous fallacy as well, because every single day, because everyone has that idea, as in if you own stocks, you think you could cash it out tomorrow, except for everyone can't cash it out because that kind of money simply doesn't exist in the system, for example, for one. And every single day, only so many shares are actually traded. That volume can be seen as a limitation to how many people can cash out, how many people can actually realize that price. So right there is a simple formula, and this simple formula applies to everything, okay? And from the ground up to pretty much every formula out there in finance. The biggest myth and the biggest problem with these formulas, as I described in actually chapter 5, I call the universal error, is people think the asset value of a stock is the same thing as cash, and it's not even close. People think that if they see $30,000 in their portfolio, they actually have $30,000 of real money. That's not true. If they have $30,000 in their portfolio in stocks, they technically have $0. I repeat, $0. Because the moment they buy a stock, they're parting with their money. Money is a finite thing, as in it is possessible, traceable. It is something we can hold, okay? On the other hand, the asset value of a stock is something that comes from the exchange of money. It's an abstraction. It's just an idea. It is not real money at all. That is why we have a $30 trillion stock market value system. That is why there's $30 trillion worth of stocks out there, but there's only $1.6 trillion of real money in circulation. I mean, the investors who are holding this $30 trillion are not even close to being entitled to it.
Wow. Okay, that's an interesting statistic. I mean, 1.6 to 30, that's something like what?
Yeah, it's
3%?
ridiculous.
3%,
Yeah, it's
something like
very,
that?
very low. Not only that, but most of
30%.
that money, yeah, but not only that, but most of that money is not even allocated to the stock market itself.
Mm,
And what I mentioned, 1.6 is hard currency, monetary base. The M2 is the most lenient measurement of money, which is also includes banknotes because we have a fractional reserve system,
right.
banking system. But that money, basically the M2, the most lenient measurement is still 13 trillion. As in, hey, that's still really far off from 30 trillion.
Yeah, yeah.
And again, that's everything in the system. When that's not even, and most of that doesn't even go to stocks. Okay, only a
Right,
fraction of that goes to stocks. So
right.
yes, exactly. So you can see where the problem is.
Okay. So you've outlined the problem pretty well, it seems. So what what suggestions, what recommendations do you think you can make to make this thing more aligned with what stocks should be rather than the fantasy that they are now?
hmm hmm So from a regulation point of view, one, stocks should be classified as gambling instruments just straight off the bat,
Hmm.
because right now you can be 18 years old and open an online trading account, but you can't play blackjack until you're 21. But right now, a lot of people already think stocks are gambling, and I think they should just be classified as gambling. Period. Now, from the stock point of view itself, I have two suggestions for that, which is one, if you're making money like Google, who makes billions and billions, you have to pay your shareholders. You have to pay dividends by law.
Hmm.
And furthermore, you have to pay reasonable dividends. You can't just make $100, give your investors a penny,
Hmm.
okay, and call it a dividend. Yes, that is a dividend because it's not zero, but we all know what that really is. It's a technicality to get around the system. And however, on the other hand, with Tesla and companies like Tesla, Spotify as well, and these startups,
Hmm.
if you don't make any money, all right, and you want to use stocks to to raise capital, sure, we'll let you do it. But here's the thing: we're not going to let your stocks trade out there in the open market and
Hmm.
let people just start playing with this Ponzi asset and Ponziing up this imaginary value of $20 to $380 while you lose billions and billions of dollars.
Hmm.
So for the startup companies, you're allowed to issue stocks, but you're not allowed to have those stocks trade until you make money,
Hmm.
until you start paying dividends,
Right.
and until you establish a monetary connection between the business and the shares and make that thing a real legitimate equity ownership instrument. Only at that point will we let you trade those stocks in the market.
All right. Well, they sound pretty sensible. I mean, yeah.
Exactly.
That really
Yeah.
links like a company's performance to the
hmm
stocks. There's a real link
Yeah.
right there.
Yeah,
Yeah.
yeah. I mean, exactly. I mean, at the end of the day, it's funny because my critics, by the way, never actually read the book. They always see a 2-minute trailer on YouTube and start criticizing it.
Right.
But at the end of the day, what am I really doing here? I'm basically trying to show people how the system works, and furthermore, I'm trying to benefit people by making these things more legitimate. In a way, I'm actually trying to fight the fight for my critics,
Right.
who
Right.
are actually the ones who love stocks and stuff and don't actually know how it works.
Right.
So,
Right. Okay.
yeah.
So, Tom, let's say you came across someone who's starting out in investing, wants to invest, or either, as a career, as a hobby, a way to prepare for his retirement, way in the future. I mean, these are concerns. And let's say
hmm
you had only enough time to tell this person one thing. What would be that one thing you'd tell him?
One thing, I
Yeah.
say avoid the Ponzi assets. That's what I would
Okay.
say. Avoid the Ponzi assets, which basically, the default to that, of course, is yeah, go into get something in real estate, something that's tangible, not
Hmm.
something imaginary,
Right.
or get something that pays reasonable dividends like Microsoft or something like that, but not the Ponzi assets like Tesla shares and
Mm-hmm.
Google shares. So.
Okay, okay, got it, got it. Okay. So, in the last minute or so of this interview, Ton, are there any last words of wisdom you'd like to share, just to inspire listeners?
I think that whether they agree with what I said or not, if they want to get involved in stocks or they have any interest in stocks, to at least go to my YouTube page and listen to the audiobook introduction, so
Hmm.
that way they understand what they're getting into.
Hmm.
And at the end of the day, like I said, I don't care if people want to gamble on stocks. What I
Hmm.
want people to understand is how this game really works,
Hmm.
because I got nothing against gambling. I got nothing against the casino industry.
Right.
I just think that I have something against a scam when people call a gambling an investing, because then it becomes a scam. So I just
Right.
want people to understand how this really works. So regardless of what they think of me and what they think of this conversation, please, if they're interested in stocks or investing, at least listen to the audiobook introduction I have on my YouTube page.
Okay, your YouTube page is?
They can just search the Ponzi factor,
Oh,
and
okay.
they'll be able to find it.
Okay.
I
Okay.
think that is actually what the channel is. I actually
Okay.
don't really remember,
All right.
but also the PonziFactor.com, and they could find me on social media by just searching the Ponzi Factor.
Right. Okay. Okay. Got that. Cool. Fantastic. So in
Hmm.
closing then, the book is The Ponzi Factor, The Simple Truth About Investment Profits. And the authors are guests, Tan Liu. So Tan,
Hmm.
thanks again for being an author story. It was very informative, and I hope our listeners pick up a lot of stuff from this. I know I
Thank
did.
you very much. Great. Thank you very much for having me. I really appreciate it.
You're welcome. You're welcome. So everyone, I invite you to check out The Ponzi Factor, and of course, please feel free to subscribe to our channel. Catch you all next time on Author Story Weekly Interviews with another amazing topic and another amazing author.